Again, just a reminder that we'll be starting in 4 minutes at 11 a.m. Thank you.
Doesn't say that you're being recorded. That we're recording in the scripts.
Good morning, everyone. My name is Sharak Shahabi-Azad, Director of Research at GRI, and I'm pleased to welcome you to today's webinar titled Bond Yields, Pension Funds, and the Art of De-risking. I will be moderating the Q&A session this morning. Before we begin, a few housekeeping details. This session is being recorded, and the recording will be shared on the GRI website in a few days. Your microphones have been muted to avoid background noise. We have allocated ample time for questions during the Q&A period at the end of the event. Please submit your questions through the chat, and we will address as many as time allows. And finally, when you exit this webinar, you'll see a prompt for our event survey. Please take a moment to fill it out. Your feedback is very important to us and helps us continue to improve our events and programming. With that, let's begin today's webinar. Pension risk is a key focus for GRI, and we've been fortunate to have a long-standing research partnership with our guest speaker today, Sébastien Betermier. Sébastien will be reviewing the findings of his recent GRI report titled Anatomy of a Shortfall, Municipal Bond Yields and Public Pension Shortfalls During the COVID-19 Crisis. This report examines a complex relationship between pension fund liabilities and bond yields. He will then expand the discussion to explore more broadly the evolving risk of government bonds with institutional portfolios in today's uncertain macroeconomic and geopolitical environment. Sébastien Betermier is Associate Professor of Finance with the Deshotels Faculty of Management at McGill University and Executive Director of the International Center for Pension Management. Sébastien also serves as Coordinator of the Finance Area at Deshotels, Faculty Director of the McGill International Portfolio Challenge, and Academic Advisor at the Bank of Canada. His work has appeared in the Wall Street Journal, the Financial Times, and Bloomberg. Sébastien, we're looking forward to hearing your presentation. Over to you.
Shorrock, thank you. Good morning. Can you hear me fine? Just double checking.
We hear you loud and clear.
Great. Welcome, everyone. Good morning. Good afternoon. This is, as Shorrock mentioned, this is a study that we've been conducting with three co-authors. David Ballas, my former student at McGill, Sarah Holland, who's a finance professor at Washington and Lee University, and Sean Wolkoff, who is a finance professor at the University of Nevada, Reno. We're very thankful for GRI for the support in doing this research. And the motivation starts here. If you look at this chart, what the chart shows is the present value in each European country, the present value of pension entitlements as a fraction of GDP. It's large. I mean, for most countries, you find that the total present value of these pension entitlements is anywhere between 400 to 500% of GDP. And what's striking when you look at this picture, which comes from Eurostat data, is that most of it is unfunded. So the gray part is the unfunded piece, the blue part is the funded piece. You do see that for some countries, like Switzerland, Norway, Iceland, Netherlands, Sweden, these are the countries with more capitalized pension systems. There you see a greater proportion that is funded, but for the most part, I mean, take countries such as Spain, France, Germany, most of it is entirely unfunded. So that is a liability for the governments. That liability matters. If you look, let's say in France, just a few weeks ago, the SP downgraded the French debt. This happened to be just a few days after the government decided to pause the pension reform. When you go through the details of the reasoning, and Moody's just did that a year earlier as well, a lot of that has to do with the large level of debt in Europe and the inability of the system to restructure that debt. And so we are seeing that these large unfunded pension liabilities are making their way now into potentially greater costs of borrowing. Now, for the bond investors, this creates risks. It creates risks in two ways. The first could be a default risk. Think, for example, of Argentina. Back in 2020, ultimately there was a settlement with creditors, but this was the 9th default by the country on its sovereign debt. So there is the risk of not being able to meet some of the debt liabilities. But even if the countries do not, you still have a risk that these unfunded fiscal shock ultimately result in inflationary policies by governments and decrease the value, the real value of the debt. So there is very interesting paper just that is currently coming out at the moment about how the risks in bond markets for bond investors depend very much on how much governments are protecting taxpayers versus bond investors. If the governments can choose to increase taxes to make sure they pay for the liabilities and protect investors at the expense of taxpayers, or they can go the other way around and go through more inflationary policies and decrease the real value of the debts, protect the taxpayers, but potentially create a loss for the bond investors. And so the greater, again, the size of these unfunded pension liabilities may ultimately result in inflationary policies leading to losses for bond investors. Now, we've talked about Europe, but North America faces similar issues. This is a recent study by Stanford faculty looking at the total size of unfunded pension liabilities in the US. And the numbers depend very much on the accounting techniques that you use to value the liabilities. But essentially, the value of the unfunded liabilities range anywhere from 1 to 2 trillion all the way to $5 trillion. That's large, very large. And we see that for some states in particular, like Illinois, or cities like Chicago, we see, again, similar to what we just saw in France a few weeks ago, we see that the rating agencies are looking very carefully at the pension debts as a driver of the credit rating, and as a result, as a driver of the cost of borrowing for the issuance entity. So this was recently, in 2025, the city of Chicago's outlook was downgraded by S&P. And part of that, again, had to do with the inability to reform its unfunded pension liabilities. So that raises a question. How are these liabilities priced in? Are bond investors requiring a higher return in exchange for bearing that risk? Here, the jury is still out. There's a few studies. Some of them do find limited evidence that municipal bond markets price the risks to the state's fiscal health arising from the large unfunded pension liabilities. So on the one hand, you have some studies saying it's not clear necessarily that we see a higher return on some of these bonds in response to the risk. But then we see, this is a very interesting study done by two faculty back in 2012, and they looked at the great financial crisis in 2008. And the premise of the study was to say, well, guess what? If we're looking at a lot of the large public sector pension plans in the US, most of them are underfunded. And so they're playing catch up by investing in riskier securities. Now, it does mean that in times of crisis, the stock market crashes, the assets go down, so the shortfall goes up. And so what the studies have looked at is it the case that in states where the shortfall increases more throughout the crisis, are these states going to have a higher cost of borrowing as a result? And that's exactly what they find. They find that municipal bond spreads in the US rose by between 7 to 15 basis points for each 10% of state-generated revenue lost by states in the lower half of the credit quality spectrum. So it seems to indicate that these liabilities increase in times of crisis because the assets fall in value, and we do see rising bond spreads during those times. So if I were to recap, and one more thing before I recap. When we talk about pension liabilities, we usually focus on the pensions themselves, but actually, if you think about the retirement liabilities, they're broader than pensions. So this is another study that I've conducted with Sarah and Sean, and we looked at OPEBs. OPEBs stands for Other Post-Employment Benefits. They're essentially retirement healthcare benefits for the most part that public sector employees for the most part would receive. And they worked very much like defined benefit pension plans. So every year that I would work for my employer, I would have perhaps a greater proportion of my future premium for healthcare throughout retirement to be paid for by the employer. And so these are additional benefits. They're large. We estimate them to be above $1 trillion. And what's interesting about these liabilities is they're mostly entirely unfunded. So most employers in the US, I would say above half of them still pay them on a pay-as-you-go basis. And so you should add them on to the pension liabilities that we just talked about. So to recap, what the existing literature says right now is, one, unfunded liabilities, the pension liabilities tend to be large and they tend to be fairly universal. You see them in most developed economies. A lot of that has to do with generous promises and population aging. Two, these unfunded pension liabilities do present risks for bond investors, whether it's default risk or inflation risk that again will result in losses in the real value of the bonds. Three, those unfunded pension liabilities do go up in times of crisis. That's important because that might be when the states need to borrow the most. And four, not just pensions. Actually, when you look at the broader spectrum, you do find that unfunded retiree healthcare promises, they add up to the pile of debt, ultimately, that the states carry. So now, that is what is motivating our research here. And the questions that we want to ask is, what is the impact of the unfunded pension liabilities on the cost of borrowing? And for that, we're going to focus on another shock, the COVID crisis in March 2020. And we're going to focus on the municipal bond markets in the US because of a few reasons. One, we have really good data on the US. And two, what's interesting about the US is we have 50 states that are all in different fiscal situations. Some of them are facing very large unfunded liabilities, some of them don't. And so it gives us very rich cross-sectional power where we can tease apart how the impact of the pension liabilities in that period of crisis is going to evolve from one state to the next, depending on the size of the shortfall and other characteristics. So I'm first going to go quickly over the data. For that, we need to start with data on municipal bond yields. So we have daily data on all the transactions of municipal bonds in the US. We get that from the Municipal Securities Rules Making Board, MSRB. That's one. It's important to make sure we understand the types of bonds we're dealing with. Are these callable bonds? Are these short-term bonds, long-term bonds? Are they insured, etc.? And so we're getting data from Mergent on the bond characteristics, so we can assign to every transaction characteristics on that bond. Three, it's important to get data on pensions. So here we have annual data on pensions assets and liabilities by a database that is publicly available. You can all go and look for data there. It's called the Public Pensions Database, the PPD. It's managed by the Center for Retirement Research at Boston College, and you have annual data on pension plans across all 50 states for something like 20, 25 years. It's a great database. And then we also keep track of the COVID cases, the daily COVID cases. So we'll have data from the New York Times COVID tracking project that we'll use as a control. The methodology goes in several steps. So the first step, again, as I was saying, we have annual data on the pension plans, assets and liabilities. It is important to track how the plans are doing throughout the crisis. So for that, we need to be able to estimate the daily asset value of each pension plan. It's not trivial, and we don't exactly know how each pension plan is going to react. We know that most of the plans were hurt during COVID because it was very much of an unknown shock, so few of the plans were protected against it. So the way we do it is we'll take the end of year asset class values. So we don't have just the value for each pension plan, we actually have it for each of the asset class inside the plan from the PPD database. And we'll assume that each asset class is invested in an index. Now, of course, the plans might do some active management, they might get some alpha component to it, but we do know that 98, 99% of the return generation comes from the beta bit, the asset allocation mix. And so we're going to assume that each asset class is invested in an index. And then, well, we have a lot of data on index values, so we're going to estimate the daily value of each asset class. So we'll take some publicly traded ETFs, exchange traded funds. We'll be able to track the value of each index. And you can see here all the way from January 2020 all the way to July 2020, we have the evolution of the different asset classes. Clearly, fixed income products did well, but equity dropped actually quite a bit by about 30%. Private equity markets dropped as well. Commodity market drops, the real estate income drops. And so we'll be able to use that variation so that we can able to track the asset value on each of the pension plans. Now, of course, you want to make sure that we do a decent job at that. And so what we'll do is at the end of the year, we have the next year's asset value at the end of 2020. So we'll be able to cross-check how the funds have been doing on each asset class, the reported values, compared to the imputed value over the course of the year. And it's going really well. So you have the R square metric, which is whenever we regress the actual performance on the index performance. The R square between 0 and 1 gives us a measure of fit. And you find that for virtually every asset class, we're predicting very well how each of the asset class of each pension plan is doing across the year. So that's reassuring in terms of knowing that we're picking up the bulk of the action through our imputation methodology. Now, then we're going to aggregate all the assets and all the liabilities across all plans in each state. So we'll have for each state a total asset and a total liability for every day. And then what we're going to do is to estimate what we call the pension shortfall. And so that's going to be the difference between the liabilities of a given state, the total liabilities of a given state on a given day, minus the total pension assets on that same day. So we'll look at the difference between liabilities and assets. And then we'll divide that by the state revenue, the annual state revenue at the beginning of the year that we're also getting from public data sources. And the nice part about having that denominator is that we can look at the shortfall as a proportion of state revenue. So if we're getting a shortfall of about 100%, what it means is that the unfunded liabilities are roughly the same size as the annual state revenue. So it gives us an anchor point for each state on the relative importance of the shortfall. And so we're going to be able to track the evolution of the shortfall every day. And the one asset that's going to move is going to be the asset piece, because again, that's the piece that is going to be moving up and down given the performance of the different asset classes. Okay, so this is a chart that gives you a sense of how underfunded the pension asset liabilities are across all the states. And you can see it varies quite a bit from Tennessee and New York all the way at the bottom, with shortfalls that are in the range of 5, 10, 12% of state revenue, all the way to Illinois at the top, that is close to 200% of state revenue. And so you see dots, the dots are at the beginning of 2019. You see the shortfall at the in diamonds at the beginning of 2020. So you see there is movement from one year to the next in the shortfall, but you also see vertically quite a bit of differences between let's say the bottom 3 states, or maybe the worst 3 states in terms of pension shortfalls at the top, the Illinois, Connecticut, and New Jersey, as opposed to the other states like Washington, New York, and Tennessee that have maintained actually relatively low shortfalls during this period. Here's another picture. You see the US state pension shortfalls at the end of 2019. This is a map of the US. You can see no clear pattern actually between which states have shortfalls or not. I mean, of course, then we can dive down, and I'm happy to expand on why, due to historical factors and other aspects, we see greater shortfalls in some states than others. But again, quite a bit of variation across the states. Now, once we impute the daily pension shortfall and we track each state all the way from January 2020 all the way to July 2020, what you're finding is, in general, and this is not surprising, the shortfalls went up. They went up right during the crisis as the asset values went down due to the stock market crash. They went up. So you have the worst 3 states, so to speak, in terms of pension debt in red, the best 3 states at the bottom in green and blue. But in general, you see some fairly parallel trends. All the states are all invested in risky assets, and they've all suffered fairly similarly, actually, during the crisis. If instead of looking at the values of the shortfalls, instead I look at the daily dispersion in the shortfall, it's actually remarkably flat. So what you see here is the standard deviation of the pension shortfall every single day. It's about 0.45%. That tells you just how much on average the shortfall differs from one state to the next. And it's actually remarkably flat, even during the periods of the crisis, because again, most of the funds suffered fairly parallel shocks in their total asset value. And so we don't see a ton of heterogeneity in how the states fared, despite differences in asset mix. during the period of the crisis. Now, we've talked about aggregating assets and liabilities. We've talked about estimating the shortfall. The next step is to estimate bond yields. And so what we do here for every single bond, since we have data at the transaction level, we're going to calculate individual bond yields. Then we're going to go and strip out components that have to do with duration and, let's say, other bond characteristics. We don't want to make sure that we're comparing, I don't know, Illinois bonds tend to be potentially long-term bonds, New York bonds tend to be slightly short-term bonds or not, but we don't want these types of factors to be driving the results. So we're having a bit of a filtering procedure that ensures that any of the bond characteristics and their impact on yields is going to be controlled for throughout the study. And then we're doing the analysis at the state level. And so we want to remove noise. There's going to be some days with more trading, less trading. We're going to calculate the average bond yield in every state in every day. And so that's going to give us a state of how each state is doing in terms of its cost of debt at every point during the crisis. There's still going to be a little bit of noise left, but in general, you'll see it right now as we're looking at the yields for, again, the top states in terms of the largest shortfalls in red, and the bottom states with the best shortfalls in blue. And you do see this is all the way going back to 2018, all the way to the beginning of 2019 and 2020. You find that, yeah, it's fairly stable. Of course, you have movements in the yields due to changing market conditions, but you do find there's about a spread of about 1.2% between, let's say, the Illinois and some of the other states, fairly stable over time. What's interesting is right during COVID, you can see a change. You can see that the cost of debt increased disproportionately so in the states with high pension shortfall in red, as opposed to states with low pension shortfall. And again, we're doing that ranking based on the shortfall at the end of 2019. If you look at the difference here between the lines, what used to be a 1% spread now jumps to, what is it, a 3.5 to 4% spread. It doubles. And you can see that it lasts throughout the duration of the crisis. It goes back again and then returns back to the 1% afterwards. And so if instead of looking at the bond yields, similar to what we were doing before, we're looking at the daily dispersion. And I'm sorry, I have a typo here. This is not this dispersion in state shortfall. This is the dispersion in bond yields. And we're tracking that through the first 6 months of 2020. What you'll find is, let's start first with the blue. The blue is the daily dispersion across all bonds. You see that it's fairly flat all the way through the beginning of March 2020. And then you start to see the dispersion going up. So there's greater heterogeneity in the cost of debt across states during the period of the crisis, and then it falls down again. Now, when we try to understand where this heterogeneity comes in, it's all coming from the yields of states with an initial shortfall above 100%. So these are going to be, again, the Illinois, the New Jersey types of states. And you can see that these bond yields jump through the roof, whereas the yields of states with a shortfall lower than 100% actually remain very stable throughout the crisis. The yields themselves may not remain stable, they do move, but there's no movement from one state to the next. The spread between the yields for given states are going to be fairly stable over time. So the daily dispersion in bond yields is going to be disproportionately driven by the bonds from states with a very large shortfall above 100% of state revenue at the end of 2019. So then that brings us now to the core of the analysis, where the goal is going to study the relationship between the daily bond yields and the daily state pension shortfalls. If you have an increase in shortfall, will that lead to an increase in the yields? And disproportionately so, perhaps, if you have a large shortfall to begin with. Now, for that, we're going to do some regression analysis. We're going to look at the slope effects. We're going to look at how significant they are. I'm not going to bore you with some of the results. I'm going to show some pictures instead, which I think are conveying the main takeaways. And it looks something like this. So if you take a picture at any point in time between, on the x-axis, the pension shortfall of a state, which again can be as low as 0 to perhaps 1 means 100% of state revenue, 2 means 200% of state revenue. And then on the y-axis, I'm going to plot the municipal bond yield of a state. It's going to look something like this. So if you were to try to fit a line through it, a linear regression, you would get something that would be upward sloping, but fairly small. You would find that most of the states would be right here in the 0.7. So that would be 70 to 80 to 90% shortfall relative to state revenue. But that analysis hides the fact that actually a better way to explain the system is actually through a more non-linear type of relation. If anything, what that relation looks like, it's more of a hockey stick shape. You can see there's a flat region on the left and there's an upward sloping region on the right. And that specification is going to explain the data a lot better. And the kink from where you switch to about 100%, the kink where you switch from the flat region to the upward sloping region is right here, right around a shortfall of 1, so about 100% of state revenue. This is when you start to see an upward sloping relation that clearly arises. So what it means below that kink is that it doesn't really matter what the shortfall is, if it's going to be between 10, 20, 30, 60% of state revenue. It doesn't really have an impact on the yields. That relationship is fairly flat. But once you move past a particular threshold, the shortfall, roughly speaking, exceeding 100% of state revenue, this is when we start to see that an increase in shortfall is going to be linked to an increase in the cost of debt. And so if to give you a sense of the magnitude, if you look on the left, New York will be one of the states with the lower shortfalls. If you look on the top right, Illinois is going to be one of the states with the highest shortfall. And you try to measure the size of the differential in the spread that has to do with that difference in shortfalls, we estimate it to be about 1.44%. That's actually a fairly significant difference in bond yields that is associated with a large difference in pension shortfalls. So now what this means is we're having a non-linear relation. It's flat for a while. It becomes upward sloping past the threshold. What this means is in good times, we may actually not see it. In good times, pension shortfalls tend to drop because asset values go up. And at that point, most of the states are going to be located in the flatter region of the space. So if you're going to be the researcher and you're going to be doing the analysis and try to link the bond yields and its relation to the shortfalls, you're not going to see much. You might actually conclude that there's no relation between the two. Or if there is, it's going to be small. However, in bad times, it's going to become a lot more obvious. Because again, in bad times, many of the states' asset values drop, the pension shortfalls go up, and you'll find more states on the upward sloping parts of that relationship. And so in a way, the nonlinearity, which is less visible in good times as pension shortfalls fall, is going to be a lot more visible in the bad times when the shortfalls increase. Now, that analysis, we've looked at a whole set of robustness tests to make sure that we're not capturing anything else. So we've looked at, could this be driven perhaps by Illinois and not other states? The answer is no. Is it driven perhaps by some states that have risk-sharing mechanisms where they share risk between members and employers? The answer is no. That 100% threshold, is it really 100%? Did we try other kink values and it seems to concentrate around that level? Is our state revenue the correct one? Perhaps there's government transfers between federal and provincial, so we tried multiple specifications. We've tried other sample periods as well, and it's actually fairly robust. And so the big conclusion is that there seems to be a very non-linear relationship between pension shortfalls and the cost of debt. If I were to summarize, the pension shortfall risks tends to result in a higher cost of borrowing past a threshold, which we estimate about 100% of state revenue. It means that if we don't see this relationship in good economic times, it doesn't mean that it's there. It means that perhaps we haven't reached that threshold for most of the states. And so that explains why, well, we shouldn't conclude necessarily that it's not there. It also means actually, and this is good news for states or governments in general, whether they're US states or other governments, that they do have wiggle room to borrow at a fairly low cost, but up to a point. And we shouldn't generalize once we're in that flat part of the surface, it may not last. Past that point, any increase in the shortfall may result in a higher cost of borrowing. And so, again, we're not used to dealing with nonlinear relations, but what it can tell us is the risk is there, but maybe not obvious for a large region of the space. And this is important because in a way, the US analysis is a bit of a canary in the coal mine. It gives us a sense of what could happen if around the world, the pension liability shortfalls continue to increase. But it also means, especially for pension plans, whenever they take on risk, especially plans that already have shortfalls and that do take on risk to play catch up, well, then in bad times, if these asset values drop, it may result in a higher shortfall and a greater cost of borrowing during the crisis, right? And these might be times when the sponsors or the states might have the hardest time and need access to that borrowing capacity. So not making normative implications about how much risk to take, but being aware of this risk for the sponsoring entity, that decreasing asset values due to risk-taking and rising shortfalls may lead precisely to higher borrowing at the times when the states might need it the most. So I'll stop here. Very glad to answer any questions or take your suggestions or stories that you've seen on your end. Thank you for giving me the opportunity to present the results of the study.
Thank you, Sebastian, for that very informative presentation. I'm going to start the Q&A with a few prepared questions that we have before we open it up for questions from the audience. If you do have a question for Sebastian, please submit it through the chat and we will try to get through as many as time allows. So my first question then, based on everything that you discussed, as a matter of strategy, then, how can pension fund managers and investment fund managers use the insights from this research to inform their investment decisions now and going forward? What are essentially the risks and opportunities that are on the horizon?
So I would say two things. First, going back to my last point, the level of risk-taking that the funds are taking at the moment, especially for pension plans that are underfunded, will have an impact in a way on the sponsor's ability to survive through a crisis, right? And so that's a risk factor that just needs to be incorporated as part of the asset allocation, let's say, exercise. So that's one. Perhaps I think the more important, maybe the more relevant questions, particularly, let's say, to Canadian types of pension funds that tend to be well-funded, so that maybe don't face that left tail type of event, is a better understanding of the risk-return trade-offs among municipal bonds, state bonds, federal bonds, not just in the US, but across countries, and better understanding how the pension shortfall risk is a risk that could be priced, not always, depending on where you are in the nonlinearity, but that could be priced. Whenever we work on bonds, we spend a lot of time on interest rate risk, on the bonds duration, on the credit risk piece, and in a way, this is increasingly a factor to take into account to better understand that risk-return trade-off in the bond space.
Thank you. There's a lot of chatter that the bond market isn't a true reflection of the current volatile economic environment. The bond market has been holding fairly steady, but we do see a lot of volatility in the equities market. What is your assessment of some of this conversation that is taking place between the disconnect between what's happening in the bond market and the equities market? How should pension fund managers view the current bond market conditions?
It's a good question. I think what it speaks to is what risk metric are we looking at here? There's indeed a lot of volatility in the equity markets. A lot of that volatility, though, is short-lasted. Equity markets tend to mean revert, much more so than bonds, actually. If you look at long horizons, there's a lot more mean reversion in equity returns that you would find in bond returns. You may not find as much volatility here on the bond market side, but the changes that we see may be more structural and potentially more permanent. So when I gave the example earlier of the French debt downgrade or the Chicago debt downgrade, potentially these are shocks that may last for long periods of time. And these shocks come from evaluations of the rating agencies about the state's ability to fix their debt issues over the long term. And so I would pay attention not just to the short-term volatility going on right now, but also to potentially structural changes that might feed into more permanent impacts on the risk and the returns.
Great. You and I had a very brief discussion before the session began about one other level of complexity that could play a factor in all of this, and that's different levels or different contracts that are governing pension funds from jurisdiction to jurisdiction, state to state, even country to country. What are the impacts of having these different contracts that do govern the pension funds? And what are the potential implications for risk / de-risking?
So that's actually a fascinating finding that we found. So far in the presentation that I gave, I focused a lot on the shortfall itself, right? And not just the change in the shortfall, but how a state that starts a crisis, like Illinois, that starts the crisis with a large existing shortfall is likely going to have a much bigger impact on the yields than perhaps another state like New York that enters the crisis with a much lower shortfall to begin with, right? So the focus was very much on the level of the shortfall. What's fascinating is once you go more in depth, you find that the contracting environment from one state to the next has a big impact on the type of risk that actually investors face. So across states, pensions tend to be constitutionally protected, but not always. Sometimes it is not an explicit clause in the Constitution. The devil's in the detail here. You find that states where the pensions are more contractually protected by the Constitution to be riskier and have a greater spread, municipal bond spread for investors. So investors are pricing that risk. In the other paper that I alluded to, where we looked at the OPEBs, the other post-employment benefits, we found that you had a whole set of other factors related to the contracting environment that matter. So for example, even if OPEBs tend to be less contractually protected than pensions, but if you are in a state where there's a lot of union power or strength in unions, it's likely going to be much harder for employers to renegotiate the terms of the OPEBs or the pensions than you would have in other states. And so that acts as a form of operating leverage that results in greater bond spreads. You find as well that depending on the healthcare plan and the risk sharing between employers and employees, that is going to be reflected in the bond spreads again to investors. So some states will, the employers will pay the full premium of the healthcare plan to retirees. Doesn't matter whether the premium goes up or down, the states will be on the hook. For some other states, the governments instead the employers will pay the premium up to capped at a given amount, dollar amount per month. So the liability is contained in that sense. You find that the more risk is shared with the employees, the less risk there is to the investors. It seems logical when I say it, but I think that the deeper conclusion here is that when you're getting into the details of the sovereign or the municipal bonds, these contracting features end up being priced. We don't always think about the microstructure and how that might ultimately result in the risk and the return, but it makes a big difference. And it's worth doing that extra mile to understand how from one state to the next, the risk of that liability will ultimately make its way to investors and what it means for any associated compensation.
Interesting. Oh, I do have a question from the audience. Do the longer-term bond yield movements reflect market participants' expectation on longer-term inflation?
So on inflation, that's a good question. What I will tell you in the context of that study is that the long-term bonds are much more exposed to the pension shortfall risk than the short-term bonds, which makes sense in a way. The states usually, or the governments, tend to have enough to continue meeting their short-term liabilities. The concerns from investors tend to be more long-term. So you end up seeing it more at the 10, 15, 20-year horizon. These are the bonds where the municipal bond spread is the highest. And so if you view that potentially as the states pursuing inflationary policies to try to deal with that debt, and that's more of a long-term features, that's exactly what we find in the data. We find that the investors require that compensation much more in the long-term bonds than in the short-term bonds.
And maybe tying in a little bit to, and you did touch on this during your presentation, but what lessons can we derive from this research at a time that many Western nations are running elevated levels of debt? What are the risks of sovereign debt? Is there a risk of a sudden downgrade or credit event? And I think you mentioned this in the context of France and Italy.
Yeah, I think we are currently entering an era where many developed economies are now facing the crunch of, or facing the consequences of many promises made for years and years, retiree promises that were unfunded. And I would say mainly in pay-as-you-go system, where it's entirely unfunded, fairly generous schemes that did not at the time take into account population aging. And you look at population aging, I mean, and Canada is no exception. We are aging as a population. Immigration has slowed down the population aging, but put aside immigration, you see the same patterns. The patterns are actually fairly extreme. I mean, if you look at in East Asia, in Japan and Korea, we're having now replacement rates, fertility rates of about, 0.7, 0.8. You need to be at about 2.0 in order to maintain the population. And so we're having more and more of a mass of the population on the retiree side, fewer on the active worker side, generous promises, no funding for these. And that debt needs to be, that those liabilities need to be paid. And we're seeing it very much finding its way in very difficult societal discussions at the government about changing the retirement age, updating the liabilities. It's very difficult to change the systems because in these pay-as-you-go types of regimes, individuals have relied on the state and on those regimes for their own pension, so they have not necessarily put aside savings on the side to counter any change in the terms of these regimes. So this is becoming an increasingly important factor that will ultimately drive the risk and the return of these bonds. In a separate study we just published online about 2 months ago, was fascinating actually. We looked at the wealth accumulation of capitalized systems, like Canada in part with the CPP reform, like Australia with the super system, like Sweden with the big reforms in the 1990s. And we compared those to some of the wealth accumulation in pay-as-you-go regimes, such as France and Germany, that are relying almost exclusively on pay-as-you-go systems in the first two pillars, the state and occupational pillars. And what we found is 30 years later, after the big reforms like CPP, whether you look at Sweden, Australia, or Canada, or other countries, other capitalized systems like the Netherlands or Denmark, you find they've accumulated 3 times as much wealth in risky assets as the pay-as-you-go regimes. And so, and we're seeing it now after years of contributions, funded contributions, after the compounding of returns. So it's becoming clear. And I think for the next 10, 15, 20 years, we're going to see much more now of a discussion between countries that have not gone through these transitions, that are struggling to meet their unfunded liabilities in light of population aging, as opposed to systems that have already reformed, that have capitalized, and that have built a lot of wealth and don't depend as much on these unfunded schemes. And that, again, will have an increasing impact in the way that we evaluate the risk and return of the fixed income products across these different systems. So long answer short, but hopefully it brings insights into perhaps not just the US, not just Canada, but actually looking at the different types of countries based on the transitions that they've taken in capitalizing the regimes 20, 30 years ago.
And some of these are quite applicable to Canada as well, in terms of, I mean, our fertility rate, replacement rate, I think, is hovering around 1.2, 1.3. So these difficult conversations, policy discussions are likely to also take place in Canada, especially in terms of our immigration policies too, because we've relied heavily on immigration to fill the void.
Certainly, and you look at Canada has capitalized quite a bit, but we have we do have a fairly big pile of unfunded liabilities through the OAS, GIS products. The CPP itself, have to remind ourselves, is partly capitalized. It's been structured so that the contribution rates moving forward stay relatively flat. So there's a deliberate design to it, which has worked actually very well overall. But we have a large proportion of private sector workers with low coverage, not much saved on the side, that are going to rely a lot on OAS, GIS, and the CPP. If the states potentially will need to come in to help out, that's going to be an unfunded liability that we haven't discussed as much yet. So perhaps not on the books, but not to ignore, given the lack of pension coverage, perhaps, and adequacy for a large proportion of the population.
Thank you. I have a question from the audience on the observed hockey stick pattern. The hockey stick effect suggests that risks compound non-linearly in stressed regimes. How could total portfolio stress testing, example scenario analysis, incorporate such convex effects into its risk transfer and capital efficiency framework?
That's a great question. So I think on the scenario analysis, the non-linearity can, I don't want to say easily, because it's not easy to do scenario analysis, right? But it can be incorporated, right? So what's important when we're looking at the different scenarios of how much debt countries will have to take on, to understand, for example, some countries may be able to take on some debt at a low cost. Past that amount, there's a non-linearity that kicks in. And so the question is, what's the kink, right? And you can do some scenario analysis on that, but incorporating the non-linearity itself in the different scenarios. What's clear in the analysis that we have is that the non-linearity is very robust. The question exactly is, where does it start? Is it at the 90%? Is it 110? Is it 125%? It looks right now that it's right about 100% of state revenue that we see the effect being built in. Those calculations will differ from country to country depending on how they're doing. But if anything, the scenario analysis is particularly well positioned to take on these features, as opposed to perhaps more pure quantitative approaches with distributions that may not be equipped to handle the nonlinearity itself.
Thank you. We are approaching time, so I think we have time for maybe another couple of questions. Most Ontario defined benefit plans currently exceed 100% funded status, and those seeking to de-risk may ask, what are the considerations for de-risking strategy at this time, given the structural headwinds?
So in general, what you find when you're looking at the optimal asset allocation of DB plans, you end up seeing a bit of a U-shaped pattern. You end up seeing that as a function of the shortfall, your level of risk taking or de-risking, if you want to take the flip of the coin, is going to depend very much on where you are relative to your full funded situation. So no shortfall. So you end up finding that usually plans that are well funded, the greater the funding they build, the more they're, if anything, use part of the surplus as a reserve for risk managing purposes, and then actually take on more risk because, if anything, provides higher returns, able to continue sustaining the plan with fairly low contributions, very efficient from a long-term cost perspective, right? When you go the other side, past, that means now you go in the shortfall region. The more you are in a shortfall, the more you end up seeing plans taking on risk to play catch up, which is fine. It makes sense to do so. If you were to invest entirely in bonds in a shortfall, you're crystallizing the loss. So it would have to come in from greater contributions. So it makes sense to see a greater risk taking when you enter in more of a shortfall area. Part of the point that we're making is watch out, because if it's a bit of a slippery slope in the sense that if you are ending up in a bad times and your shortfall keeps going up, at that point you might be part of that kink. So I think it's important when we're looking at those plans and the shortfall to understand what the shortfall means, not just for the plan, but for the issuing, the sponsoring entity, the state, and to see if the state can actually afford to bear a greater shortfall in times of crisis. And then there's one more point, which is to say that for many of the plans, especially the corporate plans that have been more under mark-to-market types of liabilities, what you have seen recently is a trend to close some of the plans more and through buy-in, buyouts of annuities and switch over to DCs. And so you've seen the trend of seeing many corporate plans coming to say, we finally got a surplus, let's close it. I don't want to deal with this anymore. Let's move to a DC. And I think that speaks to a broader issue is have the mark-to-market of the liabilities really played its role? It has potentially secured a plan, but imposed such tight restrictions that, if anything, corporations are closing their DB plans. So there's another point there once you move on to the mark-to-market of the liabilities that is also linked in a way to the whole discussion of surplus and shortfall, because you tend to see that many corporates, as soon as they move into a surplus region, close it, hoping not to get into a future shortfall anymore.
Right. And for the last question, I think is quite relevant given the current economic environment. With the nonlinear impact, given that it's most acute during market crises, how might your findings inform policy in periods of high market volatility versus more stable times?
I think what's critical is to understand for policymakers where they are on that hockey stick shape. You can take countries like Germany, for example, who have potentially wiggle room to borrow more. They've been very disciplined with some of the borrowing, and there may be room to borrow more. And so in that sense, they can potentially bear some of that risk because they're still in the flat range of the hockey stick, right? Other countries like France right now, as we're seeing with the S&P, we're seeing with Moody's, might be much more on the upward part of that stick. So in my view, the low-hanging fruit would be for the policymakers to appreciate where they are on that hockey stick, because that will determine actually their ability to bear some of that short-term risk, knowing that if you are in the flat region, you might be able to bear greater temporary shortfall without necessarily seeing a rise in your cost of borrowing. But there's a limit to that, right? It depends on where you are again relative to that threshold.
Excellent. Thank you. Ladies and gentlemen, this is all the time we have for questions. I would like to thank Sébastien for sharing his insights with us today. This has been a very informative session, and thank all of you for your participation. Before we close, I also want to let you know about other GRI resources that might be of interest. We will be opening registration in the next few weeks for GRI's 2026 Macroeconomic Policy Webinar Series. Christopher Regan from McGill University and Warren Lovely from the National Bank will be returning for their 6th year in a row to talk about the state of the economy on January 15th. Then for the 4th year running, Trevor Toome from the University of Calgary joins us on January 27th for his 2026 Fiscal Policy Outlook. On February 11th, Robert Kavsik from BMO returns for the 4th year to deliver his review of the housing market outlook and risks affecting the housing market. And finally, on February 26th, Christopher Sands from Johns Hopkins University returns to review Canada-US relations and the state of trade negotiations after what has been a very eventful year in Canada-US relations. Keep an eye on Risk Pulse for registration details on these and possibly other webinars in the series, and please do make plans to join us. Please also visit our website to read our latest research, including the latest interim report from the Second Financial Industry Forum on Artificial Intelligence, or FIFI2. The group has now held 4 workshops focusing on AI risks related to security and cybersecurity, financial crime, consumer protection, and financial stability. In addition to interim reports for each workshop, FIFI2 will produce a final report in the new year on a collaborative approach to AI threats, opportunities, and best practices. Lastly, as you leave, please take a few minutes to complete our event survey, which you should receive shortly. Your feedback is important to us as it helps us to continue to deliver the high quality programming that our members rely upon. Thank you again and have a pleasant afternoon. Thank you, Sébastien.
Thank you, Chirac.